Hello, everyone. I'm Dan Basse of Cereals Conference Lives. I'm happy to invite you to the new format here of Cereals Conference. We decided to do live this year because of the abundance of conferences around the world. But second of all, we all understand the profitability of the ag sector. Grain prices are down. Whether you're a farmer, whether you're a commercial, or whether you're an end user, everybody's making less money. And so for that reason, we thought rather than holding it at the President Wilson this year, we would try to do a live conference. The other advantage of this is it'll be streaming around the world. So we're excited about the opportunity. Now, again, we'll see how Cereals works. It's been our first attempt at this. In fact, I believe this is the first attempt in the industry, if you will, to bring this kind of a structure to you, and I hope you do enjoy it. As we look at the grain markets here today, we at Cereals and AgResource have been talking for the last 2 or 3 years about a general bearish market structure. Now, that structure really changed when, of course, the 2012 U.S. biofuels mandate became somewhat filled. In other words, we reached the ceiling and we didn't see any further growth in the biofuels industry. Thereafter, we've seen good crops around the globe, and we've seen stocks both in the United States, Europe, and many places rise based on what we consider to be somewhat stagnant demand, but demand that's not growing quite as fast as we were seeing it before. Now, we at AgResource calculate the world needs about 1.8% more calories a year to feed an ever-rising demographic and expanding population. That being said, the world's producing about 2.8% more grain each year, which is giving us this bigger pile and leading us to this price-depressing structure. We don't see any change in that, and so if you think about the grain markets going forward, they're really in that same structure of expanding global acreage and looking for lower prices and higher stocks. But as we look at where we are today, we, of course, go back and think about the 2017 global area harvested. This year at AgResource, we're actually seeing it very steady or down just modestly from last year. In fact, it's the first decline since 2010. So the market is working. As we see these lower prices, we are indeed envisioning, if you will, that the market is doing its job in terms of what's happening. Generally speaking, as we look at these periods of rising productivity last about 12 years. And so we're into this structure right now where we're probably a year or two away from still seeing some additional supplies. But in between, we see, of course, acreage really flatten out. And so we believe that the market to stabilize stocks needs to see no growth in production, harvested acreage, if you will, going forward to really get a more bullish landscape. We're not there today, so this is why the importance of weather plays so keen going forward. Now, we of course also start to see that global world inflation is going to have its first increase going back since 2011. This has got the fund community relatively excited about the opportunity to invest in commodities. And so as you see grain prices, in particular wheat, at 10-year lows, people look at these markets as an opportunity potentially on the long side, at least from the hedge fund perspective. The other, of course, big feature we've been talking about for the last 2 or 3 years is the dollar. We're going to spend a lot of time in this conference talking about President Trump, what he means for the dollar. Of course, yesterday he announced a wide-ranging tax policy change, first one since 1986, a president back then called Ronald Reagan. And so as we look at that big change in tax policy, we're going to be talking about the importance of the U.S. dollar in terms of what it means for productive capacity going forward. The dollar is the key in terms of foreign nationals expanding or showing declines in their seeded acreage. As we sit today as this conference and you look at where things are, I really have to tell everybody that we really need a blank piece of paper as we think about the grain markets for the next at least 3 to 4 months. This is, of course, the positioning of Chicago funds both in corn, soybeans, and wheat. And you can see that we are nearing a record short position on those commodities combined. And so as we look at that, that's the concern that we have today. Now, it would be very unlikely in our work that the crop year could go by without a significant weather scare somewhere, and having, of course, these funds which are now heavily short, a record short position in wheat, heavily short in corn, now moving to a short position in soybeans, holding on to those positions for an entire growing season with prices like in wheat already at decade lows. And so our bet at AgResource is, as you go through the conference and listen to the speakers, is that there will be some volatility, there will be some opportunity. It's not a one-way street this year, and I want you to think about that clean sheet of paper as we look at the markets. Everybody is bearish today. If 3 years ago, when we started to talk about a landscape of a bearish price profile, we were kind of alone in that structure. Today, everybody is there talking about the bearishness of grain markets looking forward and the limited opportunities there will be in trade. We think that somehow, somewhere, Mother Nature will have a problem. Scott Yuknis will be talking a little bit about that as we go down the line. But again, I want to reflect on everyone that the fund community is exceptionally bearish today. I'm not sure that this many people can be right. Generally speaking, I hope you enjoy this cereals conference. It's going to be something that I think you can look back upon. It is being, of course, live, so the questions and answers won't be available, but I do think the line of speakers you're going to enjoy very, very much. And so as I go forward, I'm going to introduce our first speaker here today, which is going to be Dr. Bill Tierney. Dr. Tierney, of course, is known to all of you. He's our Director of Research at AgResource Company. Dr. Tierney, of course, comes from USDA, where he's the Chief Grain Analyst. Prior to that, Dr. Tierney worked, of course, with Kansas State University, the hedge fund of Cargill, and I think his insight on the world grain markets will be well received as we think about the upcoming 6 to 9 months. So with that, I'd like to turn the next presentation over to Dr. Bill Tierney and talking about the grain markets forthcoming.
Good morning, ladies and gentlemen, or for those of you in different time zones, good afternoon. I apologize a little bit. I've got some symptoms of allergies and my voice is a little bit cracking up, so I apologize here. My responsibility today is to quickly review what our view is of the global wheat and corn outlook. Of course, we will start with wheat. I'm trying to advance the slide. We're going to advance the slide. Hold on. Thank you again for your patience. There we go. Everything works if you give it enough time. So we're going to talk about the wheat outlook first. Just a quick visual as to where we are now in relation to where we've come from. Our initial view, since we are so close to the most critical stage of crop development for the winter wheat crops in the Northern Hemisphere, we're just beginning to plant the spring wheat crops in the Northern Hemisphere, so there's a lot of fundamentals still in play. But our initial view, based on the assumption of trend yields and what we think total wheat planted area will be, not only in the Northern Hemisphere, but also in the Southern Hemisphere, our view is that we're going to probably go back minimally and test that $160 a ton level that we set last year. We don't see anything in the fundamentals that would stop us from getting there without a significant crop problem developing in a major wheat exporting country. If we break below that, then that will be probably due to some fundamental changes that we don't yet see. In terms of global supply, we're looking for a global wheat supply to be up roughly 5 million metric tons from last year, so it will be a record. And in terms of stocks, we are looking for global wheat stocks to use to be the highest in some 20 years. This is a relatively dramatic development. It is due to a variety of factors, certainly one of them being record yields in major wheat exporting countries, but it's also due to the fact that China has been building huge stocks of wheat. Our data that we're going to be showing in these charts related to China is based off the USDA's balance sheets. We understand that there is a lot of controversy, not only outside of China, but within China as to exactly how large grain stocks are, since there are no officially published end-of-year stocks estimates. But using USDA's numbers, we can see that much of the growth, not all of it, but much of the growth in global grain stocks has come in China. And this year, this upcoming year, we're expecting to see China's stocks exceed 100% of annual usage. Among major exporters, again, based on the assumption of trend yields, not the record yields that we saw last year, particularly in the United States and Russia, but based on the assumption of trend yields, we're looking at exporters' supply to be down roughly 7 million metric tons from last year. Now, what does this mean? Well, when we plug in what we believe to be reasonable assumptions on consumption growth next year, with some decline in global wheat feeding, we're expecting to see, actually that's an error there, it should be 2017-18 major exporters ending stocks to use will be the second highest in 7 years, but it will be down from last year's level. So last year's level is the crosshatched square on the right, and next year's level is the hollow square on the right. What's the significance of exporter stocks to use? It's difficult to model wheat prices based on any single country's supply-demand. So you have to start looking at global supply-demand variables to try to explain what wheat prices are likely to do. It's our belief that over the last 10 or 12 years, probably the dominant factor that's been driving global wheat prices is year-to-year changes in the ending stocks to use of major wheat exporters. So over the last 10 to 12 years, it's the annual changes in stocks to use ratio that we believe has been driving the major part of the move in wheat prices. So as you can see, the pattern here is that wheat stocks fell very sharply in 2007-08, grew up in 2009-10, went down again, a second decline in 2012-13 and 13-14, and then has been growing. But next year, we are projecting tentatively to decline slightly. This chart over the same time period shows what prices have been at the Gulf on a July-June basis for the two principal varieties of wheat shipped out of the Gulf, hard red winter wheat, which is in green, soft red winter wheat, which is in red, and in orange, we've also plotted Gulf corn prices. Now, we think that in certain years, corn prices are an important determinant of wheat prices. That's particularly true if corn prices independently are in a rally mode, as in 2012-13, when the U.S. saw its worst drought in 50 years, having a significant impact on U.S. corn yields, with U.S. corn yields dropping about 24% below trend that year. So rising corn prices pushed up wheat prices. Secondly, when wheat prices are in oversupply, as they have been in recent years, it is unlikely that you will see wheat prices at the Gulf fall below corn prices at the Gulf, simply because corn acts as a floor under wheat prices, and wheat can't go below corn prices. So one of the other variables that we think influences wheat prices on a year-to-year basis is corn prices. This last graph combines the two charts that I showed you previously. The blue bars are the stocks-to-use ratio of major exporters, and the lines are the prices at the Gulf. As you can see, there's a very strong, I believe, a strong correlation in that when wheat stocks are low, exporter stocks are low, wheat prices go up. When exporter stocks rise, wheat prices go down. Our forecast for next year, we're predicting a relatively small decline, but still a decline in season average prices for U.S. hard red winter wheat, Gulf soft red winter wheat, and we're also projecting a a modest decline in Gulf corn prices for next year. Okay, so that's our global view of wheat supply and demand with a primary focus on exporter supply and demand. But there's always wild cards, and we'll be spending some time today giving you more details about them. One of them, and I think there are many wild cards, but probably the most important one, the one that's most likely to impact the market, is Russian weather and or changes in Russian agricultural policy. When I worked at USDA, I was introduced to the notion of zones of high-risk agriculture, or periods of high-risk agriculture. And because I was the wheat economist in charge of the wheat supply-demand projections, we spent a lot of time looking at Russian weather. And it was reinforced that much of the Russian wheat crop is produced in a zone of high-risk agriculture that is susceptible to droughts, with some regions having severe drought more than half the time every 10 years. One of the other things that is likely to, or could impact the Russian supply-demand balance sheet is the actual pace of exports in the current marketing year. Currently, the pace of exports, denoted in the red line, is lagging what is needed to meet the USDA's export projection of 28 million metric tons. If it does not recover, and given the problems that Russia and Turkey are having right now, it may be that going into next year, we could see beginning stocks of Russia could be possibly as much as 13 million metric tons. With the assumption of trend yields and an increase in exports next year, we think that Russia's stocks to use will decline slightly from this year, but still be at relatively elevated levels. So again, I want to emphasize that while stocks to use are likely to go down relative to this year, they're still expected to be at relatively elevated levels and have a price depressing effect. The other thing that we have to be concerned about with regard to Russia is the impact that state intervention has on market prices. These are several occasions when actions taken by Russia, at times coordinated with the Ukraine and Kazakhstan, had a dramatic impact on wheat prices. We think that anything that Russia does to either restrict exports or tax exports, or perhaps impacts on exports to principal markets, as in the case of this year, in the case of Turkey, could have an impact on market prices. This is something that is unforecastable. We can't put probabilities around it. We just have to acknowledge that it's something that has happened and could happen again in the future, and therefore we have to be constantly aware of that risk. The next part of my presentation will be taking a look at global corn outlook. In terms of outlook, again, I'll start off with a look at prices. Without a weather scare, it's our view that corn prices will work their way lower. If you take a look at spot prices, the lowest prices today are the prices from the U.S., but if you look out to August and September, the blue line shows that bids out of Argentina are significantly lower, and it could well be that bids out of Brazil will match or equal the lows that we are currently seeing in Argentina. It's just recently that we've seen sufficient volume in forward pricing activity in Brazil that we have some confidence regarding Brazilian forward prices. But given the size of the Brazilian crop as currently estimated, and expecting that there will be sufficient incentive for farmers in Brazil to sell their stocks, we think that there's a very good chance that Brazilian exports of corn will be at much higher than this year, and could, at least on the balance sheet, match the record exports that they did last year. We are currently not projecting that that will be the case, but certainly the current forward price structure indicates that global corn prices are going to be going down. And as I said, the only thing that is likely to stop that is a significant weather scare, most likely due to developments here in the United States. Global corn supply next year, we think will be up approximately 3 million metric tons. Global stocks to use, however, is relatively unchanged. Statistically, it's up by about 0.2 of a percentage point. That's not enough to say anything other than say it's going to be unchanged. It's noteworthy that this will be the 4th year in a row that global stocks to use has been at an elevated level, roughly 22 to 23%, and has remained relatively unchanged. The most significant development in the global stock situation is that corn stocks in China, based off of USDA's estimate of stocks and based off of some forward projections for China's corn area and the subsidies that the Chinese government is offering to corn processors, we're looking for China's stocks to use ratio to be down. But it's noteworthy that if you look at the rest of the world, minus China's corn stocks, actual corn stocks are up. So if you take China out of the global grain balance sheet, the picture that you get is the rest of the world's actually seeing corn stocks go up. That would have occurred this year, except for the extraordinary steps that the Chinese government has taken to try to reduce their corn stocks. We'll talk a bit more about this in just a few more slides. Exporters' stocks to use, unlike the situation with regard to wheat, is projected to grow significantly next year. Again, this is based on the assumption of trend yields and what we think right now is reasonable assumptions in terms of growth of demand. Here again, if you go back to the idea that it's exporters' stocks to use, which has a primary effect on global corn prices, the blue bars show the year-to-year changes in the stocks to use ratio, whereas the lines represent prices. The green line is the U.S. Gulf. The red line is Argentina, and China's corn prices are denoted by the orange circles. The only reason we've seen a decline in China's prices is because of changes in China's support prices for the reserve and also very aggressive sales. Last year, for the first time since China introduced a temporary corn reserve, China sold off its corn stocks at average prices that were 25% below the acquisition price. And this does not include the cost of interest and storage for 3 or 4 years. So China clearly signaled that they are going to be disposing of their stocks, even if it means dramatic fiscal losses for the Chinese government. One of the things I think we have to be concerned about in terms of the outlook for corn this year is the possibility that we have a monster Brazilian corn crop. This is a chart that was put together by our Brazilian practice. If you take a look at the column at the top, right-hand column, you'll note that there's 4 lines. The blue line represents the moisture that Mato Grosso received up to this point in time relative to the evapotranspiration index. The yellow line, that was 2 years ago when they had a record crop. The yellow line represents last year's disastrous crop, and the green line represents moisture to date. So as you can see, we are in a much better moisture situation than we were last year, and we are in a much better situation than we were 2 years ago when Brazil had a record crop. Now, what does this mean? Well, if you take a look at CONAB, which is the lead agency for crop production estimates in Brazil, 8 out of the last 10 years, CONAB's April production estimate has been too low. If you take a look at the 2015 crop, the one 2 years ago, their crop estimate in April was 8% too low. If you take the average error in the years that CONAB underestimated and you apply it to this year's estimate, it suggests a crop of 96 million metric tons, and some respected Brazilian consultancies have estimates as high as 97 and 98 million metric tons. What we think this means, along with our expectations of next year's acreage and production in both Brazil and Argentina and the Ukraine, is that we are going to see intense competition from what we call the ABUs, Australia, Argentina, Brazil, and the Ukraine. We think that next year they will capture over 50% of total global corn exports, and that in aggregate they will have record exports of about 75 million metric tons. Now let's talk a little bit more about China and the somewhat revolutionary changes we've seen in Chinese ag policy as it impacts on corn. I think the first thing I want to point out, something that gets almost no press and very little analysis, is that just 2 years ago, China was the world's largest feed importer. Even as they were building the world's largest corn stocks, they were at the same time becoming the world's largest feed importer, importing roughly 41 million metric tons of feed. Since then, because of the change in policy, there's been a sharp decline in feed, and feed imports this year are estimated to be roughly 19 million metric tons, and next year we think 15 million metric tons. So people need to understand that some of the strength that has supported the market over the last few years is this artificial demand that was created by Chinese agricultural policy, which is rapidly changing. And it could be, depending on what happens regarding trade negotiations between U.S. and China, depending on how low Chinese corn prices fall, it could be that China could be an exporter of corn next year, but that's not currently in our view. Now, what does this all mean in terms of prices? Well, unlike the situation for wheat, where it is the Black Sea or Russia that is the world's largest exporter, in the case of corn, the U.S. is still the world's largest exporter, and you can get some insight into what corn prices are going to do by looking at just the U.S. balance sheet. So what this chart does is take a look at the relationship between U.S. corn prices, season average corn prices, relative to the stocks-to-use ratio as is published in the U.S. WASDE report. So this is the actual historical final stocks-to-use ratio, and this is the season average cash price. Currently, we are projecting that stocks-to-use ratio in the United States will rise next year to roughly 17.6%, and we're looking for a season average cash price of about $3.25. That's $128 metric ton. If you take a look at a futures-based model, which uses futures prices the other day and plugs them into what the equivalent cash equivalent would be, the futures model right now is saying that prices are going to be $3.70, whereas our fundamental model says they're going to be $3.25. However, we believe that the price response of U.S. corn prices has been greatly skewed by the ever-growing impact of ethanol consumption of corn in the United States. If, however, corn fundamentals begin to return back to the levels, the responsiveness that they had prior to the introduction of ethanol mandates, and ethanol mandates were introduced in 2005, then you may slip down to the level shown in 2005 and in 2004. The model says that if you look at an expanded model that includes the ethanol era as well as the pre-ethanol era, at least from a fundamental perspective, with supply-demand at roughly 17.6%, national average corn prices could fall to $2.50. So this is a question of whether or not The structure of U.S. corn prices is going to return slowly back down to the way it was prior to the growth of ethanol consumption. Without ethanol consumption growing, with yields growing, with increasing export competition, this is a significant fundamental threat, but we're not calling for it at this time, but I'm pointing out that it's something that we could see. So if anyone has any questions related to my presentation or any other of the presentations, feel free to contact me by email at this address. Thank you very much.
Bill, that was really good. Thank you for your enlightening comments on corn and wheat. Just a few questions from here. If someone's looking at the December corn market today, and we have December corn at about $3.89 here this morning, where do you think the peak would be if we had a weather scare this summer? How high could we go? Again, not a dire drought, because I don't think that's in the forecast, but if you had a few weather abnormalities, where could you see December corn on the upside?
Well, I don't think it's going to go as high as what we had last year, because last year in June, the market was still processing the impact of the terrible safrinha crop in Brazil. So if you base it just off U.S. fundamentals, I would say anywhere from 30 to 40 cents below the highs that we set last year. So the highs last year, I think 30 to 40 cents of that was the Brazilian effect. The rest of that was concern about U.S. crop yields.
So in other words, if we think about December corn at 4 to 4.20, it's really hard to get much above that relative to that 30 or 40 cents pullback. Last year we made a high at just under 4.50 a bushel. So, somewhere in the 4 to 4.10, you would say that's pretty much the upside potential unless you just have a dire drought.
I believe so.
Okay. The other question I have, Bill, a little bit is on wheat. If you look at the wheat market here today, is there a class that you favor in wheat relative to another class? In other words, is there a balance sheet that looks tighter to you than others, which would say I'd rather be in a hard wheat class or a soft wheat or a white wheat? What do you think on those?
Well, our work suggests that it's the higher protein wheats, the spring wheats, Canadian spring wheat, U.S. spring wheat, Russia, Kazakh spring wheat, that is going to have the tightest supply. It's interesting that the market for high protein spring wheat is probably the most price inelastic. So it's no surprise that in February 2009, I believe, it was the Minneapolis market that set a $20 high, whereas the Kansas City market was $15 and the Chicago market was $12. There's almost no price response to demand for high protein wheat. So if there are significant problems in spring wheat supply demand, I think you could see very sharp movements without having much of an impact on hard red winter wheat futures, or Matif futures, or Chicago futures. So it's probably spring wheat that's the one that is most susceptible to a rally. And since we haven't even got it planted yet, we have the least amount of information about its supply and demand.
Bill, thank you very much. Enlightening, and again, thank you for your time and good presentation. Thanks. When we look at the global oilseed markets, it's one of oversupply. I don't think that's new to anybody. And as I get into the outlook, we're going to start this presentation talking about world oilseed supplies and how 2017-2018 is the world of is the year of soybeans or the year of oilseeds. It's just a very bearish oversupply situation, but thankfully, as we get into the end of the presentation, there's a couple wild cards that could give us some bullish surprises. I really want to highlight where FOB prices have been. And as we look back historically, we, of course, saw the high last June and July, late June and early July, as the South American crop problems became digested by price, and we had that run up to about $480 a ton on a FOB basis relative Brazil. Then the Brazilians stepped out of the market, leaving the U.S. to, of course, see this tremendous export demand that really culminated here sometime in the late part of March. The U.S. looks to export about 2.05 billion bushels of soybeans this year. And now, as you see in the blue line here, Argentina has now captured the low-cost selling price in the marketplace. But again, we're starting to see the U.S. become competitive in terms of opportunities later this year. Now, that big break we saw in the soybean market just in the last really 6 weeks is really promulgated by Brazil and Argentina. We're looking at a record large 168 million metric ton crop down there. That crop, of course, features 112 million metric ton Brazilian crop, an Argentinian crop at around 57 million metric tons, and it's at additional really 14 million metric tons above last year, which has spiked the bean market lower at least over the last 6 weeks and taken us where we are today, where soybeans on a spot basis are hovering 20 cents either above or near the $9.50 mark. As we look at veg oil prices during this price drop, notice that whether it's canola in Canada, which of course has been the upside leader, Dutch rapeseed oil, Central Illinois soybean oil, Ukrainian sun or Brazilian soy oil, those markets have been relatively tame. In other words, we've seen a decline in price in Chicago futures, but on a cash basis, the market's been generally going sideways. Some of this, of course, is due to what we call a better demand. We have seen, of course, palm oil supplies start to increase, which has been a depressant on palm oil prices recently here, as shown on the black line. But as you see, the veg oil market has a much stronger profile, and in terms of its contribution to crush, has been much better than, of course, meal or anything else going forward. As we look at the major oilseed production, the growth continues. Again, this is the year of oilseeds. AgResource has delineated that back in late 2016, and that it would be that world farmers would be planting more sun, would be planting more soy, would be planting more canola, cottonseed. And so as we look at productivity capacity, this is going to be a new record high in terms of total oilseed production, somewhere around 560 million metric tons. And so we have sizable oilseed crops around the world. There are some problems, but in a general sense, it's the sunflower market which is showing the most growth over the last couple of years because of what's happening in the Black Sea, followed by soybeans on a percentage basis. And so those are the keys as we see it today. No shortage of oilseeds around the world from a supply situation. As we look at world stock use ratios, though, we are not near the record levels. Those record levels are way up at around 22.5%. This year, we're at around 20%. And so from a stock use ratio, combining all of the major oilseeds, soy, rape, peanut, and sun, you can see that we're well below that high. And this, of course, sets up the stage. As for the demand profile, we'll be talking in soybeans in just a little bit. But again, I want to point out that even with these record supplies of soy around the world, we just don't have the stock use ratio that would take us to that point. Now, we're estimating at AgResource that the world's soybean crop in 17 and 18, this, of course, will be in the WASDE report that comes out on May 10th, will be 347.6 million metric tons. That's up about 1.6 million metric tons, or 0.4% from last year. Now, we do expect that maybe world soy yields will drop a little bit closer to trend. Notice that big increase here in the last crop year in terms of harvested yield. We're expecting that to come back a little closer to trend, still above trend, mind you, due to genetics, but from a standpoint of acreage, it will be a new record high. Nonetheless, the point I'm trying to make here, including a Brazilian soybean crop next year of around 106 million metric tons, is that the world is not going to see the same kind of growth in oilseed production in the upcoming 17-18 crop year that we have seen last year. So everybody needs to be aware of that. I think the market today has digested the South American crop size and the large seedings in the United States. Expect that going forward, we're going to see more normality. And if you do that on trend, you don't see the real bearishness that we'd expect to see down the road. The other thing I think that's very interesting in the United States when we think about the productive capacity in this country is that we've seen 3 years of record soybean yields, and the question becomes, can it happen in a fourth year, which would be also a record? Now, again, there have been agronomic changes in the United States, but as we look at it at AgResource, we think it's very difficult to pop another record yield for U.S. soybeans this year. In fact, if you had a more normal yield of, let's call it 47.9 or 48 bushels an acre, that, of course, would pull us back in terms of productive capacity where the stocks increase would not be tremendous. So, again, as we look at it, if we look at the soybean market currently, we're utilizing a trendline yield in the United States. Notice that every 7 to 9 years, there's a sharp break in U.S. soybean yield due to weather, whether that be, of course, a severe flooding or drought. Those yields tend to be some 16 to 15% below normal, but at least in this crop year, we see no reason to start out with with anything but trend. Looking forward, though, we think it's difficult to set another record high, or at least historically it would be against the odds to do it this year. World supplies of soybeans coming into the crop year, adding, of course, beginning stocks in production, will be record large. Brazil is the main feature on that, with a soybean crop that will be up somewhere in the vicinity of 14 to 15 million metric tons bigger than last year. Argentinians the same. U.S. seedings will be up. And so when we look at total supplies, as I said earlier, we do have a record large cache of beans and oilseeds around the world. This takes our stock use ratio from a world exporter, including soy meal, up to 23.6%. So again, this is going to be the highest in 6 years. And so this is where the bearishness would come in the soybean market. And one of the reasons we dropped about $1.30, at least in the last 6 weeks, because of the Brazilian offerings and because as where we see it here today. U.S. soybean stocks will be the highest in a decade. AgResource is forecasting them at a little over 13 million metric tons. For new crop, we're looking at that number to be closer to 16.7 million metric tons. That would be a record. So again, the stock profile of soybeans seems to be abundant. We'll talk about price in a few minutes. But again, notice how different the U.S. stock situation is from the period going back to 2007. U.S. soybean stocks are again getting back to a position of oversupply. The key going forward is whether demand will be able to keep up with the supply bump we're seeing in the three primary producers of Argentina, Brazil, and the United States. Notice that a lot of these soybeans are now domiciled in places like the United States and Argentina. Argentina, of course, is still the world's storehouse of soy, whether you look at USDA data. But even from the United States, because of the bump higher, we do see that as an opportunity. Now, in Brazil, they are normally not stores of beans any long periods of time. So we would imagine, even though the Brazilian farmer is not a big seller here today, that he will be a seller as we move into the crop year, probably liquidating supply more abundantly as we look at the June, July, and August timeframe. But at least for today, with the Brazilian farmer having sold about 60% of his crop, he is not a big seller as we see it here and now. The thing about soybeans, I mentioned, it's a little bit like the Chinese chasing the drum of supply, is we do have record demand as we look at the soy complex here today. World global soy demand, as estimated by AgResource, will be up about 9.3 million metric tons, 2.8% next year. That's a sizable increase, and again, will help absorb some of these larger crops. Now, at AgResource, we're thinking the Chinese will import 90 million metric tons of soybeans this year. In the next upcoming new crop year, that number could be upwards of 94 to 96 million metric tons. So, assuming a better crush rate for potential biodiesel, as we'll talk a little bit down the road here in the later part of the presentation, this is an opportunity to think about the expansion of demand that we're now seeing in the world soy demand. And as evidenced by records of Brazilian exports, as we look at, and this gives you a graphic of soy being in red, total meal trade being in green, and corn being in black. Of course, the Brazilians are not big corn exporters until we get down the pipe and we get their safrinha corn crop harvested. But as you see today, Brazilian exports are record large, the April number being very close to 11 million metric tons. So the Brazilians have been very active in exporting soy. When we combine that with the United States, it was a record first quarter of demand in terms of world soy trade, which is why the bean market likely stopped in this 925 to 950 area to pause to see in terms of what the U.S. crop will be doing in the new growing season. Another way to look at this and to highlight the record demand, if we go back and we look at Brazilian exports on a monthly basis, you can see that February, March, and April are record large. We do start to see a seasonal decline in Brazilian trade going forward then. But again, we're encouraged that this record export pace is persisting. We've gone back and given you the 15, 14, and 16 crop years as measurements here. And again, very robust start. In fact, as we look at it in the next graphic, you can see here that soy trade, at least today, 16 to 17, is up a little over 4.4 million metric tons, and we think by the end of July it could be a 6 million metric ton advantage. And so, again, remembering that Brazil produced a 14 million metric ton increase in their crop this year, already we've shipped out the door by the end of July, by our estimates, an extra 6 million tons of soybeans, which helps, at least for the moment, add some stability to the market. The other thing I want to talk about just a little bit, because we think it's important in terms of world canola prices and world soy oil prices, is that China has ended its rapeseed oil auctions. Of course, it was auctioning oil roughly for the last 2 years, or let's call it 17 months. And you can see here that Chinese rape supplies, at least as stored from USDA data, has now dropped back to a little over 2 million metric tons, or just under that number. So we now have seen those auctions end. The Chinese, of course, were auctioning off 100,000 tons of canola oil or rape oil per week to meet domestic demand. That has now ended, and we're starting to see the Chinese become much more aptly buying the Canadian canola market, both in a old crop and new crop position. The Chinese are already lining up some sales, at least from the September forward time frame, to make some opportunities going forward. The other thing I think everybody needs to be aware of is the competitive opportunities or the advantage that the U.S. may have in terms of soybeans relative to Brazil in a time frame from late summer into early autumn. This is a graphic that shows you the U.S. Gulf compared to Paranaguá and Brazil. You can, of course, see the differences relative to 16 on the left and 17 here today. And again, the U.S. has an advantage, if you will, in selling soy off the Gulf or off the PNW to China. Now, there's always a premium for Brazilian soybeans because they are higher in an oil content. So that higher oil content does allow about a 15 or 20 cent advantage in terms of Brazilian soy. But as you see here, when we look at the Paranaguá offering soybeans this September, the U.S. should really get some opportunity to sell soy in that August, Sep, and October time frame. And we think this is another reason why the market will at least be supported until we start to see some more evidence of a U.S. soybean yield above trend. Chinese crush margins, which seasonally always tend to decline into the April timeframe, are starting a seasonal rebound here. You can see that crush margins, at least on the forward crush margin, are turning back to the upside. The red line, of course, is the spot soybean crush margin, which is still negative. But this will be another encouragement, we believe, as we go forward, if margins in China continue to improve for the, of course, Chinese buyer to step forward. And that's why AgResource is estimating that China will take 90 million metric tons of soybeans this year, potentially more than that in the year to come. Chinese crush rates are also very strong as you look at the domestic meal market here. This is, of course, Chinese weekly crush. You can see the crush rate here being up closer to 1.8 million metric tons in the last week. As margins expand, we should see the Chinese crush go forward. But the Chinese crush data on a weekly basis gives us confidence anyway that the Chinese crush will be somewhere around 87 million metric tons this year. And so with that 87 million metric ton crush number, we do feel better and more confident, at least, that the Chinese will take 90 million metric tons from all sources. When we think about soybeans here into the month of June, the modeling would suggest anyway that the price of range should be somewhere between $9.25 and $9.85 a bushel relative to spot futures. Now we're going to be going into delivery on May soybeans here, of course, on Friday. We're now moving over to the July contract. We believe without a weather problem, it'll be very difficult to get July soybeans much above $9.85 a bushel. That being said, if you notice that the soybean market is also strongly influenced by corn, if we stay way too wet in terms of the Midwest, and we do have issues with either corn emergence or corn ponding or corn seeding of the last portions of the crop, corn may offer a bullish tailwind to the soybean market that could take us up against $10. But again, $9.85 to $10 as we see it here today will be a very tough resistance zone to get above in soybeans unless we have a more significant drought either in the United States or places like China. Our new crop target on the downside, based on stock use ratios, would indicate a target of $8.79 a bushel, based on exporter major stock use ratios of 22.3%, and corn, as Dr. Tierney talked about, falling to $3.20 or $3.30 a bushel. Now, USDA is projecting it in their February Outlook conference a price target of $9.35. AgResource is going to be lower than that, but you can, again, it's difficult for us to really forecast a harvest this low. Let's use a median of $8.50 a bushel. And so that's what we're thinking as a downside price target for November soybeans. Thus, if you're a producer or a trader and we see rallies back in November soybeans to $9.90 to $10.20, that would be your next selling opportunity in the bean market as we see it here today on any kind of weather scare rally heading into the late spring or summer. Now, there is one bullish wild card to the bean market that everybody in Europe and everywhere around the world needs to understand. We call it the political wild card of biodiesel. Now, we all know that soy oil and heating oil have been very well correlated over the time frame from 2006 up all the way up to about where we are today. That's, of course, due to biofuel policies around the world. But recently, President Trump, who's been kind of a wild card for agriculture and his impacts on ag markets are unknown, yesterday he, of course, announced that he was going to sign papers that were going to get the United States out of NAFTA. This morning, we learned that he's talked to the Mexican president and the Canadian president, and they're now going to stay in NAFTA and start a negotiation process. So that whole thing about trade is up in the air, and ag traders need to be, of course, watching it very carefully. The other problem is what we call the renewable fuel standard. The RFS today is set by the EPA, which was established last November. We do not expect those mandates to be substantially changed. And so when you look at those mandates in biodiesel, which are the most important, they will be rising to 2 billion gallons this year and then 2.1 billion gallons next year. And of course, that's the chart on the left that's highlighted here. The other change, of course, will be the renewable fuel standards in ethanol, and they will be moving back up towards 15 million gallons this year, with the possibility in terms of the standard moving higher than that in a longer-term basis. Now, as we see, the biofuel is really biodiesel, which captures our attention nearby. And that's because yesterday we had Senator Grassley, who's pictured here in the left, introduce a bill to, of course, allow the producer credit program to go forward. Now, currently, the United States is importing a large share of its biodiesel from overseas. And then when you, of course, import that biodiesel from overseas, you, of course, get a dollar credit that's applied. And it's one reason why biodiesel imports have been so robust. Last year, Argentinian biodiesel imports surpassed 2 million metric tons. The Argentinians have already backed off because the dollar credit is no longer available to those biodiesel producers in Argentina. The other thing that may happen is with Indonesia, they of course export biodiesel in terms of palm oil to the United States. Now, all combined, we would estimate that import of biofuels into the United States could exceed 5 billion pounds. Now, in U.S. exports or U.S. end stocks of soybean oil is only 2.2 billion pounds. You can imagine the dislocation that this would have if we move to a producer credit only. Our bet at AgResource is that about half of the producer credit in biodiesels would be made up of soybean oil, some 41 to 44%. And so there's a tremendous risk to the end stock profile that could give an upward jolt to the soybean market, maybe as high as something like 42 to 46 cents if the producer credit was enacted. So it's something that people in Chicago and traders around the world are watching very carefully. This is a political headwind or wild card that we really don't know how to measure. We don't have any idea if it's going to come out in a month from now or maybe 6 months from now. As we see it here today, though, we will have a WTO trade dumping ruling coming out in the first week of May between the 7th and 8th. And so I want to tell everybody that soybean oil does have some bullish potential here based on the political wild card of a producer credit in biodiesel or, of course, the diminishment of U.S. imports of biodiesel through a trade dumping and higher tariffs that the U.S. may quickly follow with. So these are things that everybody needs to be thinking of. If you want to be bullish of something in the soy complex, it's soybean oil, and we would be buyers of oil relative to meal, thinking that that contribution to crush can reach record highs if the producer credit is enacted. Last chart here would be, of course, canola imports, and we are forecasting record large canola imports just because we'd have to get the oil from some other station, probably from the north. As you notice, the Canadian soy oil stock situation is extremely tight, even with record crop production. Canola prices have been rising. Canola prices are now at 4-year highs, And as we look at the canola market going forward, we see bullishness to continue. So the spread between canola oil and soybean oil is likely to reach record levels. We are actually bullish of canola, bearish of soybeans. But if you got the biodiesel surprise, as I call it, you may see November soybeans rising back to 10, 20. That would be a selling opportunity, assuming that the Midwest is not seeing any sustained hot, dry weather during the summer period. Our view on the soybean market, and just in summary, is that November soybeans could drop to $8.50 a bushel for harvest lows, sell rallies above $10, assuming weather looks generally favorable. And longer term, we do think that the soybean market, with another large Brazilian or South American crop, could even reach down to $8, but that may not happen until the spring of 2018. Thanks again. I'm Dan Basse. We'll come back with the next speaker, which will talk about European wheat, being Mr. Noel Fryer.
Ladies and gentlemen, good morning. My name is Noel Fryer, and I'm here to delve into a little more detail about one of the prime movers of the agricultural markets around the world, and that is Black Sea and EU wheat. Just a little hint before we start. There are going to be quite a lot of slides, quite a lot of numbers. If you focus on the little red arrow on each slide, you will be focusing on the number about which I am talking. That should help with the logic of the argument. So I'm going to start with the EU, and I'm going to start with the importance of feed numbers. Those of you who've seen this presentation before know just how much I see this as a problem, and the reason is that between the official Brussels numbers and the USDA numbers, there is systematically a major difference. Back in 13-14, Brussels was 4 million tons below the USDA. In 14-15, it was 3 million below. A year ago, they were almost 5 million below, and in the current campaign, they are over 5 million tons lower than what the USDA is using. That's a total of 17 million tons difference over the 4 years, and it's all because the EU has no stock reports. The EU is not in a position to do what the USDA does when it presents its US balance sheets, which is, instead of talking about feed, they talk about feed residual, which is a kind of statistical slush factor which enables the balance sheets to balance. This year we have an additional problem in terms of EU corn and soy meal imports. USDA currently projecting EU corn imports at 13 million tons. The current import pace suggests it's going to be no more than 10. That's 3 million less than the USDA. Similarly, on soy meal, they are projecting 19.5 million tons, but the current import pace is no more than 17. So between corn and meal, we've got another 6 million tons missing, if you like, in the EU feeding complex. This is important simply because what it does is give us a 5 million ton spread between what Brussels is using as end stocks for this season and what the USDA is using, 15 million against 10 million. Now, the Brussels number of 15 million is about 5 weeks supply, whereas the USDA at 10 million is about 3 weeks supply. Now, bear in mind that these stocks are as of the 1st of July, and the bulk of the EU harvest does not occur until August. So according to the USDA, the EU runs out of wheat around about the 24th of July. If those stocks to use ratios were applied to the US balance sheet, the Brussels number would equate to about 215 million bushels of end stocks. The USDA number would equate to 130 million bushels of end stocks, and you don't need me to tell you that wheat wouldn't be at 425 today if they were looking at 130 million bushel end stock. We are using currently for feed a 57 million ton number, so slightly below the USDA, but we have a significantly smaller export number of 23.5 against both Brussels and the USDA at 25.5. We simply do not see the demand against the current shipments of about 21.5 million tons. We do not see the demand to get to the USDA's number. That gives us a current end stock for this campaign of 13 million tons, and that leads us to look at the 17-18 S&D. On the left, you have the EU wheat area, which, as you can see, is not expected to change very much. On the right, you have a 36-year trend yield, which currently shows about 5.7 tons per hectare, which, sorry about the arrows there, which would give a 154 million ton crop. The range on the crop is 145 to 161 basis the high and the low of that trend channel. I am currently using 151, i.e. slightly below trend, to account for the recent dryness that France and Spain in particular have been experiencing. That gives us a supply for the coming year of about 169, 170 million tons, or 3 million tons more than this year. And again, those of you who have seen this presentation before will know that one of the basic tenets of what we try to do here in terms of identifying what the exportable surplus is that we keep domestic use and end stocks unchanged on the year. The reason we do this simply is because, as I showed you a little earlier on, nobody actually knows what they are. So if you got through this year with that domestic use and the end stocks, then you can do it again next year. The bottom line of all that for 17-18 EU wheat is an exportable surplus of 26, 27 million tons. And the only real thing on paper, in theory, that the EU has to worry about is weather. However, if Madame Le Pen wins next week, they will also have, I think, some pretty serious currency concerns to worry about, like a diving euro, which if you add any weather problems, we know how the farmers will react to a weaker currency and a weather issue. Okay, let's turn to Russia's 2017-2018, but here again we have a problem with the stocks numbers. My current number for Russian end stocks of this campaign is 16.5 million tons, which is 5 million higher than what the USDA is using. The reason for this is, firstly, that the USDA is using a higher domestic number, although my number, I think, is closer to what many in the trade are using. But they also are using a much higher export number of 28 million tons against current shipments, which stand at about 22.5. Now, for us to see over 5 million tons shipped in the last 2 months of the campaign, given the current demand, given the slowdown in shipments, we simply do not see this as feasible. So if you look at the crop prospects, again, the area on the left-hand side, you see a relatively small difference, possible small increase, and a 22-year trend yield for Russian wheat comes out at about 2.5 tons per hectare, and that is a 68 million crop. That's 5 million tons down on last year, but because of the higher stock number, the higher carry-in, you have a 5.5 million ton increase in supply. Once again, unchanged domestic use and unchanged end stocks, and we get an exportable surplus of about 31 million tons. Bear in mind, once again, what we are doing here is what the market is doing. We're trying to focus on the supply side of the equation. We are not yet addressing the world demand issues. That comes at a later date. Now, if you really want to get aggressive and take Russian end stocks down to where they were at the start of this campaign, I'm sorry, I will go back on that. I just want to point out one thing. We have several people who are saying that my 16-17 export number of 25.5 is low. It doesn't really matter, because if you put it up to 27, all you do is take the carryout down to 15. That is still a big number, and if you maintain the concept of unchanged stocks for the coming year, your exportable surplus remains at 31. And if you really want to be aggressive and take Russian end stocks down to where they were at the start of this campaign, okay, only 8 months ago, the exportable Russian surplus balloons over 40 million tons. Or to put it one final way, you can take the crop down to 64 million tons, and you still have an exportable surplus which is equal to this year. So whichever way you turn it, it looks like Russia has plenty of wheat. The only thing we have to watch is the weather, and I would urge you to listen very carefully to Scott Yuknis, who is coming on later, because he has some very interesting things to say about potential weather issues in the region. Okay, let's finish up with Ukraine. Once again, the area looks unlikely to change very much, but Ukraine wheat yields are a slightly different animal compared to the EU and Russia. They're different in the sense that trying to establish what trend yield might be depends very much on the time frame that you choose. This is a 22-year time frame, giving a trend yield of about 3.6 and a crop of 24 million tons. Whereas if I shorten that to a 17-year time frame, the trend rises to about 3.8 and the crop jumps 2.5 million tons. 2.5 million tons might not seem a lot, but when we look at the balance sheet, it becomes quite important. For now, I'm going with the low end of the Ukraine production estimate. It's a 15% drop in yield from last year, but last year was so outstanding that I don't want to overestimate what could happen this year. You will notice that the carry-in was also down on last year, and we are left with a total supply something between 4 and 5 million tons down on last year, which, given the unchanged use and end stocks, takes 4.5 million tons out of the exportable surplus. Now, this is a significant number. However, I would suggest that one particular aspect of the world market this year that needs to be watched with regard to Ukraine is India. That's because in last year's, or the current year's export number, Ukraine probably exported around 3 million tons to India, who were major importers for the first time in 10 years. Much will depend on whether the official numbers of a record Indian crop are correct, as to whether India comes back, as many in the trade think they will, for a similar 4 to 5 million tons. If they do, and as Ukraine is one of the few countries that can actually supply the phyto certificates that the Indians like, then the Ukraine wheat supply demand will have to be monitored very carefully if that production number turns out to be correct. So what does the combined S&D show? Well, basically, using our numbers, we have a slight reduction in the production, but a 4 million ton increase in supply, total supply, thanks to the higher carry-in, and with the unchanged usage in end stocks, we've got about a 4 million ton increase in the exportable surplus to 70 million tons. Now again, if you were to take the combined stocks down to where they were at the start of this campaign, i.e. just 7-8 months ago, around 25-26 million tons, that exportable surplus rises to almost 10 million tons above the current year. So again, in theory, it looks like the EU and the Black Sea have plenty of wheat. And I would just like to say here a couple of things about price. If you go back 2 years ago, April 2015, the new crop FOB price then was $200, which was approximately 11,900 rubles. Going back 1 year, the FOB price was about $25 less, but the ruble price was still the same as a result of the currency. As of today, the new crop FOB price is about where it was last year at $175, but the ruble price is down 17%. Unchanged dollar price, 70% drop in the ruble price. That leaves the farmer not particularly happy. And you would expect him to be a pretty reluctant seller if he can store what he's got. But on the other hand, Balkan wheat, notably Romanian wheat, which is an equivalent quality, is also offered at $175. So there is potentially big harvest competition without a weather issue. On the other hand, do you want to be short the cheapest wheat in the world, which Russian wheat is? For harvest, it's about $8 cheaper than hardwood winter 11% protein. Those two proteins, in fact, are equivalent given the different moisture calculations. That discount rises to $20 by over $20 by December. Getting grain out of the Russian farmer may become increasingly difficult if and when we understand what these new VAT issues, how they will actually work. And always remember that over the last 10 to 12 years, any major crop issues in the Black Sea have been as a result of summer weather problems, not winter or spring. Again, if we go back 1 year to when we held this conference in Geneva, in the time between the date of the conference and the final production numbers, the EU crop went down 10 million tons, the Russian crop went up 15 million tons, and the Ukraine crop went up 10 million tons. So the scope for something to happen to these crops over the next 3 to 4 months remains significant. Just a resume of the parameters that we have used so far. EU yield we have up 4% on last year. Russia is down 6%. Ukraine is down 15%. Bottom line of that is a small reduction in crop, but despite that, an increase in the exportable surplus. That's it. Thank you. If you have any questions, Dan has a question. I thought you weren't going to do this to me.
No. We're going to have some fun here. So the dryness in France today is now some of the worst we've seen going back in 20 years. Has it had an impact on the crop, or what do you think, or where would you put the estimate now?
I think my personal number on the French crop is 34, 35. I think it has had an impact. It's maybe just a little too early to say because the current forecast does look much better from the weekend. There is quite significant rain coming in. But there is one thing to bear in mind also, and that is that I think the crop is late because it is so cold. When I called home today, it was snowing in Geneva.
Okay. The other question that sticks in my mind, we're all talking about a world wheat market that maybe has smaller supplies. Of course, in Europe, you have record low supplies coming into the new crop season in terms of carryover, at least by some measures, by USDA. And again, you got to remember, we're doing this from Chicago. So we'll give the USDA credit. But that being said, do world wheat prices need to get below the last 2 year lows between, let's call it 167, 166 to $170 a ton?
Again, it will depend on what you're talking in terms of wheat. There was a Tunisian trade today, this week, which reflected about $166 FOB in the Black Sea for 11.5 protein wheat. The Russian wheat at 172 for harvest, 180 for Dees. Going forward, as I said, is a significant discount to hard red. And when you look at all the problems, potential problems in North American spring wheat plantings, and the record low U.S. acreage, the weather, the cold, etc. I would, if I were a farmer, I would not be selling anything that I didn't absolutely have to sell down at these prices. And there is one other point which I would like to add. For reasons best known to himself, I think it was the Russian finance minister about 3 weeks ago said he was expecting the ruble to fall below 65 by the end of 2017.
So end users should be looking at Black Sea new crop wheat at 169.72 as a buy, I guess. And my next question, I'm going to take you a little bit afield here. I'm going to go to North Africa, Egypt. You know, what's going to happen if the Egyptian farmer, you're telling all the farmers aren't going to sell, but what if the Egyptian farmer doesn't sell to the government?
Then I guess if they at some stage they have to, they don't have any choice. But I guess that means that GASC would have to come in and fill the gap with imported wheat. It's kind of interesting that after that spate of like 4 or 5 tenders, whatever it was, in 7 weeks, they've now gone 7 weeks without a tender. So, and they haven't bought very much domestic wheat so far this season. So Egypt is a little difficult to assess, particularly with the Egyptian pound now at 18.20. It's just a disaster for Egyptian foreign exchange reserves.
Okay. Well, thank you very much again, Noel. It's no time to be bearish of wheat, but we don't know what the market does until we know more about new crop supplies. That takes me to a hard break here. This is a hard break. This is a 15-minute break. We will all return here at a quarter to the hour, so you can get up, take a longer drink, go to the longer bathroom break, but we will be back in 15 minutes. We're going to start out with Dr. Scott Yuknis, and we're going to talk about world weather, and of course, this follows Noel's presentation, what he's expecting for Europe and the Black Sea. Again, thank you very much, Noel. Great presentation. Thanks, everybody. We're now going to go down, and we're going to come back in 15 minutes. Take care. Bye-bye. Cereals Conference is live for the second part of today's discussion. We're now going to have Dr. Scott Yuknis talk about weather and the upcoming opportunities for the Midwest. Now, Scott and I were talking. Scott's a pioneer, if you will, in terms of ENSO and ocean temperatures. He worked with the Oceanography Department of the Navy and chasing Soviet submarines, trying to understand thermal units of the oceans prior to go. So with that, I've used Climate Impact Company a long, long time. I've known Scott going back to, I think, the early 2000s. What we really like about Scott's work is that he helps us give us the hot spots of where there's going to be problems last year. At Cereals in Europe last year, he, of course, did a video conference, and he said there would not be a drought in the Midwest, even though every other forecaster around the world was talking about that. So I give him lots of credit, and I'm very anxious to listen about his forecast for the upcoming growing season across the Northern Hemisphere. Scott, this podium is yours.
Thank you, Dan, and good afternoon to everyone, or good morning, depending what part of the world you're in. So we're live here at Cereals 2017. And my name is Scott Yuknis. As Dan was saying, I'm the president of a climate impact company. And what we're going to be doing today is trying to figure out what the hot spots across the global climate as it pertains to crops will be located. So leading into the conference, of course, we were mainly concerned with the United States and with a warm North Atlantic, maybe the possibility of some dryness developing, but boy, it's turned wet in recent days, and looks like that pattern's going to continue. Dr. Olivia Kellner will be following me and talking about the U.S. pattern. So what we're going to be doing is exploring the rest of the globe to see what drought risk, that's our hotspot focus for today's presentation. Of course, we always start off with the ENSO. Is El Nino going to form? And it does look like there's a chance of a weak El Nino later this year, but it's been a hot topic in the markets. Is the El Nino similar to the 2015-2016 El Nino coming back? We don't think that's going to happen, and we'll talk about that here to lead off the presentation. We'll also talk about, of course, soil moisture trends, a very important aspect of climate forecasting. Now, there is some risk of important drought this year. Our focus today is going to be on Southeast Europe up into western portions of Russia, Southwest Russia, possibly the Ukraine. So that's a very important crop area, and the patterns do suggest that dryness and important is going to develop during the summer season there. Other areas are also important, of course. There's already some drought established in southern India, northwest portions of India. Will that continue? And of course, we'll be looking at Southeast Asia and into the southern hemisphere, Argentina, Brazil, of course, part of today's presentation. So let's get into it. Now, the first slide is very important. It shows the nature of climate forecasting in this current era. First of all, one thing that I wanted to leave with you, one impression with this slide, is that we're looking at all aspects of the global sea surface temperature anomaly pattern to forecast climate, not just ENSO. Here's a good reason. Who would have thought that the first quarter of 2017 would be producing record flooding in Colombia, Ecuador, down into northern Peru without the presence of an El Nino? And there wasn't. Technically, neutral ENSO was in place the first part of this year. But if you look at the slide, you notice that the warm water off the northwest coast of South America led to that flooding. Now, that warmth in April has shifted off to the east. We look like we have a very weak sort of El Nino-like pattern out there now, but we don't think El Nino is going to develop anytime soon. Other aspects of the global climate which are really important, Indian Ocean dipole looks like it's going to go into the positive phase for this year. That means that the western portion of the Indian Ocean turns warm, feeding convection up into Asia, causing a climate pattern change there. And to the east, a dry pattern is likely to form later this year, southeast portions of Asia down into Australia. And it could be pretty bad, especially if the weak El Nino joins in with that. Then, of course, we hop over to the Atlantic. It's warmer than normal. That's a big influence, a big factor on the European, the Western Russia climate for this upcoming summer. Also notice that cool pool south and southeast of Greenland. That's a problem. That could encourage a low pressure trough to develop during the summer. If that happens to the east, a big ridge, and that's what we're going to be forecasting, a ridge pattern developing over eastern, southeastern Europe into western Russia as we get into the summer season, and that will lead to some dry and hot weather. We'll have details on that in just a couple of minutes. Well, as far as the El Nino, I think this is very telling. If you look at the slide on the left, you can see that the ensembles are all over the place as far as what ENSO is going to do in 2017. It could be neutral, could be even a fairly strong El Nino is possible. The average scenario, that black line, shows an El Nino developing for the second half of 2017. But if you look at the statistical models, which are essentially analogs, they all show a neutral ENSO for the rest of 2017. So El Nino is very uncertain right now. Another reason for El Nino being uncertain, look at that slide on the right. That's the subsurface equatorial Pacific leading into the 2015-2016 El Nino. Lots of red. That means that the East Pacific equatorial region in the subsurface is very warm. And of course, a big El Nino followed. Look on the left, that's the current situation. The waters are cooler than normal in the subsurface East Pacific, so any attempt at El Nino in the short term over the next 3 to 6 months is going to fail. I would say, though, from a market perspective, there will be periods when El Nino looks like it's going to develop, and I think that will make market news. But because of the lack of warming in the subsurface, that warming will be a bit of a curveball. It will tend to cool off in 2 or 3 weeks, and we'll be backing away from an El Nino. So sort of back and forth on whether El Nino is going to develop over the next 3 to 6 months. The El Nino should hold off until later this year. Won't be as strong as the 2015-2016 event. Now, if El Nino does develop over the June, July, August into September period, typically what happens, sort of an old-fashioned climatology here, the warm, South America tends to be very warm in the northwest, northeast sections. Argentina is wet. It's dry in the Caribbean, and that will affect tropical cyclones in the North Atlantic basin. Indonesia, Northeast Australia tend to be dry. India tends to be dry. These conditions might develop for different reasons, at least for Indonesia and Australia, mostly related to the Indian Ocean dipole. So we're going to be talking about that as well. Before we get into the forecast section, one final thing, very important, global soil moisture trend. Let's start with North America. Well, it was dry in the mid-south portion of the United States not too long ago, but we have a Madden-Julian oscillation-driven wet pattern that has unfolded. Lots of severe weather and very heavy rainfall is going to eliminate that drought. So as we go into the summer season, it looks like only the southeast U.S. will be affected by drought. Of course, the west had that very wet winter, wet soils out that way. Further south, down into South America, lots of rain over northwestern portions of the continent due to that warm pattern off the northwest coast of South America. That's important. That's not a crop area. But to the east of that, it's all subsidence. And Brazil has dried out. Looks like it's going to stay dry for most of 2017. Further south, Argentina's been in and out of some dry and wet weather. Looks like in this pattern, though, that the wet trend is going to return. Now let's move over to Europe. Big high pressure dominated the European winter and into spring. That caused dryness over Western Europe and most recently Southeast Europe and into Turkey. Now last year there was a big drought over northwestern portions of Russia into northern Europe, north central and central Russia. That dry pattern is still there, but it has weakened somewhat over the last couple of months, and that trend should last at least through spring into early summer. Further south, India, the northwest portion of India, that's a new drought area. We're concerned about that. Southern India has been in drought for a while. That looks like it's going to continue at least for April, maybe some changes for early summer there. Southeast Asia is very wet. And down into Australia, it's been wet across the western part of the continent and some dryness over the southeast portion of the continent. Australia is a hot spot. If that positive phase of the Indian Ocean dipole and an El Nino comes on, the historical pattern for Australia is very dry prior to next summer, central and eastern portions of Australia. So we're definitely concerned about that. So the forecasts that you're going to be looking at today are based on the sea surface temperature anomaly pattern that you just saw. We're projecting that forward for the next 6 months and correlating that with what happens historically in the upper atmosphere. This is what we came up with. For Europe, for May and June, the big low-pressure trough, which has emerged recently over north-central Russia, that pattern is going to stay there, but shift a little bit to the west. So it looks like we're going to go into a trough pattern over northern Europe for the first part of summer. That's important because at the base of that trough, there'll be some rain shower activity, which will become pretty persistent late spring, early summer over southeast Europe. And that's a drought area right now. So there could be what we think will be temporary relief before another pattern change follows. The big ridge over the western portion of Europe for winter into early spring, still there, but it lowers its latitude somewhat, still intense, but located over Spain. Now, as we get into the July and August timeframe, that trough is going to move off to the west, retrograde, if you will, towards that cool pool of water that I mentioned earlier over the north-central North Atlantic. It may not be as strong as what the charts are showing here, but what will happen with that pattern to the east, a big ridge is going to form over eastern and southeastern Europe and into Russia. That spells trouble, some hot weather, and some anomalous heat. dryness, I should say. Now, as far as the forecast charts, let's put this into a much more easy way to understand what we're looking at in terms of a forecast. Now, for May, the main thing to be looking at here, there will be some rainfall over southeastern portions of Europe and down into Turkey. It's going to be brief. It's been dry down there. We're going to see some brief shower activity in May, bringing some brief relief to the planting season and so forth, but that's going to change once we get into the summer season. And you can see the June, July, August forecast for Europe and into Western Russia looks very hot for southeastern portions of Europe and up towards Ukraine. And you can also see that that's a dry sector. The wet sector moves back towards the western portions of Europe. The dry pattern that we've been seeing in France, Western Germany, and so forth, that should subside as we go through the summer season. Now, as the soil moisture starts to dry out, especially midsummer, that's when the anomalous heat, we can get into heat waves that can last for many days at a time. The main risk of that is going to be the second half of summer. During the autumn, we're expecting the El Nino pattern that I mentioned to come on, and what that means is a turn towards a wetter climate in Europe. Now, we're pushing this idea of high pressure, dry, and drought potential and anomalous heat for summer, and we think that definitely will happen. But it's not something that's going to last well into the autumn season. As the El Nino comes on in southern Europe, at least parts of southern Europe will have a tendency to turn wet. Let's take a look at Russia. First, just in conclusion with a European summary, the hot spot is southeast Europe for drought over the summer season. So that's probably the most prominent forecast that we're making today, the most confident one. Let's move to the east to Russia. We mentioned that trough in the upper air pattern for May and June over northern Europe. Well, to the east of that, there's going to be a ridge pattern. So we're looking at southwestern portions of Russia down towards the Black Sea, Caspian Sea, and then northeast from there being beneath a high-pressure ridge, which is going to develop dry and warmer than normal climate. So soil moisture trend certainly trending dry for the first part of the warm season. Then we get into July and August. That high pressure ridge is going to amplify over western Russia and the heat's going to settle in. This will include southwest Russia, the wheat growing areas down towards into the Ukraine, and also between the Caspian and the Black Sea. So a very high profile forecast there for sure. In terms of the charts, looking at what May has to offer, it's warmer than normal across Western Europe, down towards the Ukraine. Could be some extreme temperatures for the first part of, late spring and into the first part of early summer. Definitely trending drier there. And then you can see once we get into June, July, and August, it's warmer and drier than normal. Risk of extreme heat for western and southwestern Russia down towards Ukraine and in between the Caspian and the Black Sea. So that's definitely a hot spot. We're looking at September and October, November. Is there going to be any early Arctic air and freeze and so forth? Nothing extraordinary. It still looks like the climate pattern is warmer than normal into the autumn season. So for hot spots, all major wheat-growing areas of southwest, south portions of Russia down towards Ukraine, down towards the Black Sea, the Caspian Sea, all of these areas are beneath that high-pressure ridge that I described, which develops over the summer season. The high impact is mostly July 15th to August 1st and forward from there. It'll take time for these conditions to develop prior to that point. Now let's take a look at Southeast Asia. For May and June, somewhat benign. Really the only interesting thing, I think, is high pressure ridging over northeast China. So some hot weather, some dry weather for early summer over northeast China. But once we get into July and August, the high pressure expands across China, and we're looking at a dry and hot scenario developing for the second half of summer. The forecast charts show that dryness and heat over northeast China during the month of May, and some dryness over east central China developing, but the main focus here is the dryness that evolves June, July, and August. You can see that across eastern and central China it does turn drier than normal. The soils are generally wet there now, so we don't have any current issues, but my concern is that the pattern change is going to occur about midsummer and beyond towards dryness, and leading to those changes would be the positive phase of the Indian Ocean dipole and the gradual development of El Nino. So it's a pretty confident forecast. Is the dryness going to be significant enough to cause a drought? Probably not. We're not sure. We're going to be monitoring that very closely. Once we get into September, October, November, still some lingering dryness in the eastern portions of China. By this time, Southeast Asia is going to be a hot spot for dryness. So no drought areas to start the summer for China, but the possible hot spots are dryness and heat developing late this summer for eastern China. Now let's take a look at India. Well, it's dry in southwest India now, but we're looking at some fairly significant rain for May and into early summer. That may put a dent in the drought pattern down there briefly, but similar to Southeast Europe, we expect dryness to come back as we get into the main portion of the summer season. For June, July, and August, there you see it. Dry conditions across southern India, also northern India, and of course hotter than normal. This is based somewhat on a constructed analog. We looked at some of the modeling to make this forecast. The modeling is a little wetter than the analog presentation that you're looking at here this morning. So confidence isn't tremendously high in this forecast, but there's drought already in place in many of these areas. It's going to be difficult to curb that. Taking a look at the next slide for September, October, November, you can see Southeast Asia. It's a hot spot. El Nino should be developing by that time, and it will be turning drier. Northwest and South India, northwest and south portions of India are the hot spots leading into the warm season for India, definitely because drought is established there already. And potentially later this year, East China, later this summer I should say, is a potential for an emerging drought. And also, as I mentioned, Southeast Asia with the El Nino developing, drought conditions there for later this year. Well, talk about hot spots. Australia. We're concerned that the combination of both the positive phase of the Indian Ocean dipole and an El Nino could lead to a dramatic situation in Australia ahead of their next summer. So central and eastern portions of Australia look very dry for later this year. That could lead to some problems of agriculture for their late spring and into next summer. For South America, dryness in Brazil continues. It looks like that's going to actually amplify backing into Mato Grosso, which has had some periods of wet weather in the last several months, but the dryness is likely to expand over the next 6 months for Brazil. That's not the case for Argentina. A wet regime is expected down there. In Africa, there's been strong dryness in South Africa of late. That dryness will probably linger over extreme southern portions of Africa over the next 6 months, but a mixed bag as you go north into the tropics. So no major risk areas there. As we end today's conference, Dan wanted me to make a point about 2018. Well, it's difficult to make a climate forecast at this point, but one thing that we're pretty confident about is the nature of the global oceans being warmer than normal. We don't see any change in that. Over the last 5 years, the global oceans have been either the warmest or second warmest on record. That's affecting the nature of ENSO. What it is doing, it's leading to a warmer than normal climate. So for the most part, climate, both summer and winter seasons, is going to be averaging warmer than normal. And as Dr. Olivia Kellner will be telling you about here shortly, the nature of precipitation events is going to be extreme. There can be long periods of dryness and all of a sudden an interruption by a very wet weather event. And this climate pattern represented by the ocean expectations for 2018 certainly promotes that idea. Now, you can follow all these forecasts with Climate Impact Company. We do week 2 to 4 forecasts for North and South America, Europe, Russia, China, Australia, all of these areas, and the seasonal outlooks as well on the Climate Impact Company website. AgResource has all of this information as well. So lots of information for you to look at and to follow, and I encourage you to follow these situations because not all of these forecasts are super confident, so we need to be monitoring very closely. So with that, I'm going to be turning it over to Dan, and I'll be introducing Olivia Kellner in just a moment.
So Scott, everybody just has a few questions for you as you think about your presentation. Sure. If you were to give me your number one area to be focused on over the next 6 months, where would that be?
Southeast Europe, Ukraine, and Southwest Russia. I think that dryness there and a hot summer is going to happen. It's a question of timing. It may be midsummer, late summer when the highest impacts develop. So prior to that, the conditions may not be as extreme. But as we get into mid and late summer, those conditions look like a very confident forecast right now. That's the main interest that we have at this point.
The other thing as a grain trade we keep thinking about, is China ever going to have another weather problem? I mean, we always wonder. They've had like 12 good crops in a row. I know they're using lots of irrigation. Do you see anything in the forefront for them?
Well, I worked hard to try and come up with some sort of an extreme anomaly, but they're looking good right now. The soil moisture conditions are generally good for crops. But with the changing climate pattern towards an El Nino and the Indian Ocean dipole change, there's definitely the risk of some drier weather during the summer period, later in the summer period. So there's risk of some dryness. Whether it causes a drought, a major impact on agriculture, I'm not sure I don't think that's going to happen at this point.
Last question for you. I just got back from Australia.
Okay.
Just everybody down there is all concerned about the upcoming season. They're all talking El Nino down there, but you don't really see it in having a big
No,
problem.
I don't see it over the next 3 to 6 months. If it does develop, it'll be very weak. It's something that will develop later in 2017, but definitely having an impact on Australian climate. I think the main problem down there, it doesn't receive as much press, is the positive phase of the Indian Ocean dipole. That is a much more prominent and confident forecast, and that does relate to dryness in Australia. So I think that's the climate variable that we need to be looking at more closely versus ENSO.
Great. Thank you again, Scott. Wonderful presentation. I'll let you introduce Olivia, if you would, and go forward on her.
Okay. Thank you very much, Dan. And thank you, everyone, for watching the presentation this morning. It's my pleasure now to introduce to you Dr. Olivia Kellner. She'll be doing a presentation on the warm season for the United States, which, of course, is very prominent for the markets. Olivia is a climate specialist. Has her PhD, and she is extremely prominent knowledge on climate change. And she's going to be talking a little bit about that in today's presentation as well. And of course, the summer outlook for the upcoming season in the U.S. So I'm going to hand it over to Olivia.
Thank you for that introduction, Scott. Honored to be here today and give you all the climate outlook for the growing season. I will begin today with a quick summary of what we saw in regards to fall and winter 2016 and heading into 2017. Overall, we were warmer and had regions of dry pockets across the United States. So our fall, as you can see, had record warmth across the continental United States, and we had dryness mainly into the southeast and Gulf states. Heading into the winter, we were very warm across east of the Rockies essentially and into the American Southwest, with cool weather up in the American Northwest. Dryness kind of persisted through the central Ohio River, Mississippi River Valley in Missouri, Illinois, and then we had dryness still lingering within the southeast United States. Luckily for California, they saw plenty of rainfall and their drought was alleviated. So why did we have these weather patterns that we saw over the fall and winter? There was a struggling La Nina that was attempting to try and establish itself across the equatorial Pacific, but we had warmer sea surface temperatures remain in place across regions of the Pacific that kind of helped moderate what the La Nina was supposed to bring. We also had a warm Atlantic across the east coast of North America, which helped moderate our temperatures as well. So looking ahead into this growing season, what are we expecting? Models are suggesting that another El Nino is trying to establish itself. Is this on the horizon? That's a very good question. When we look at our dynamic models versus our statistical models, they're not in agreement. So the statistical models are holding neutral, dynamical models are favoring an El Nino into the forecast. Climate Impact Company, we both feel, Scott and I, that if a El Nino were to develop, it's going to be later into the season, so July, August, September, not really impacting this growing season this year in the United States, but it'll be mild if one arises. So the potential for yield impacts across the Corn Belt, what does that mean? Right now, we don't see or expect drastic impacts to yields across the Great Plains and the Midwest. If anything, if the El Nino becomes established through this late summer into fall and winter, it will more likely impact the yields heading into 2018 growing season. Our soil moisture right now, as you can see, we have pockets of dryness still in the southeast. We still have some lingering through California, Southern California and the Southwest United States, Oklahoma, Arkansas, and then east of the Rockies, Colorado into Kansas. Pretty common areas for dryness, at least coming out of the patterns that we've seen. However, heading into the growing season, what do we expect with this dryness pattern? So we expect increasing dryness across the upper Midwest, around the Great Lakes region, and across the Southwest United States. We're expecting a wetter trend up through Mississippi, Louisiana, into Arkansas, Missouri, and this is due to an active Madden-Julian oscillation. It's the main driver of the rainfall expected to come into the region through the next coming weeks. And as El Nino, or the INSO Southern Oscillation, remains in a neutral phase, the Madden-Julian oscillation tends to be an active driver of these wet weather events. So we are likely to see a wetter trend through the lower Mississippi River Valley. And with that, that can also look or help to moderate our temperatures heading into the warmer months. So looking at May and June 2017, you can see the temperature forecast expects warmer temperatures across mainly the southern half of the U.S., with a trough establishing itself kind of over the Midwest. And we're expecting cooler temperatures across the upper Midwest and Great Plains. With precipitation, you can see that wet swath up north, south to north from the Mississippi River Valley into the Midwest, wetness along the upper East Coast and Northwest United States, and then dryness extending into the upper Midwest and then across the Southwest. Heading into July and August, we can see the coolness remains with temperature across the northern Great Plains, and then we have warmer temperatures from mainly the Midwest, or not the Midwest, sorry, the southern half of the United States south. With that, temperatures aren't expected to be drastically hot, just warmer than normal. And then you can see the rains return across to the Midwest United States and east of the Rockies, which is good. This is our primary growing regions. So all in all, we expect adequate rainfall in July and August, and seasonal temperatures, slightly warmer temperatures across the majority of the growing region. And this is important, as we know, July, August with corn and soybean crops, but specifically with corn, this is when we go into grain fill, so we're not expecting high stress degree days. We're not expecting intense water stress at this time, and that looks to be optimistic for the growing season this year. So our forecast confidence at Climate Impact Company for the warm season outlook is on a scale of 1 to 5. We're ranking it at a 3. We're at mid-confidence. So we wanted to explain to you why we have a 2 missing point contributing factor. And this is mainly because the global climate has shifted into a new cycle. It's the warmest it's been since record keeping began. We have increased levels of carbon dioxide in the atmosphere, and climate models still greatly struggle to forecast our shorter time frame climate drivers, such as the Madden-Julian oscillation, North Atlantic oscillation, Arctic oscillation. And all of these climate drivers do impact short-term weather trends, so on scales of weeks to maybe a month, which can drive a one-time event that can create drastic flooding and could ultimately impact crops. So on top of that, with our global climate system warming, what we've seen happen over the years is that shift to more warmer weather, more hotter extreme temperatures, and then we've seen this increase in precipitation. And with that, as you can see from the National Climate Assessment map I've provided, this increase in precipitation and heavy rainfall events specifically has been noted. So what we've expected statistically to happen in a warmer climate, we are actually witnessing occurring in the United States. So this happens, or is happening, I should say, in a warming system because global circulation is greatly impacted by the temperature differences between air masses at the poles and the equator. As you can see in the diagram that I've provided, the circulation cells, the Hadley cells, are actually taller and fatter at the equator than the polar circulation cells up at the poles, which are shorter and skinnier. This is driven just by simple physical properties that warmer air is less dense. It rises, so a column of air is taller at the equator versus the same amount of air at the poles. It's colder, it's denser, so it's more compact. Where you get these circulation cells meeting, which I have circled in yellow, this is where our jet streams form. So the slope of the slope of the circulation cells between the different circulation cells is what drives our wind speeds. If we warm our climate system, as represented here in the slide, we get a relaxation of the gradient of the slope between the jet streams, and this reduces the speed of our jet streams, and in the end, this causes the pattern of the jet streams and our weather patterns to change. So when we have a stronger jet stream, when we have more temperature differences or a stronger gradient between the poles and the equator, we see less variability in temperatures, so less drastic swing in temperatures. We have milder seasons and more consistent weather patterns. When our climate system warms, our jet stream weakens, the flow reduces, so we tend to get a more meridional or meandering pattern. So then we get plunges of cold air and we get really strong surges of warm air across the United States. So as our climate system warms and continues to warm, as we have been seeing, we're going to see these more variable shifts in climate, which in the end will impact not only this growing season, but growing seasons in the future. And then modeling our future climate, it's come a long way. It's a great resource, and it allows us to test how well our climate forecasts are verifying, in the future. So this is called hindcasting, and the hindcasting shows that while our climate models are relatively accurate and account for increased levels of carbon dioxide, we're still seeing reduction in accuracy or less accurate climate forecasts because we can compare it to climate data. And with that, there is uncertainty in future predictions of our climate forecasts, of our seasonal outlooks, because they're failing to capture the smaller scale climate drivers, like I said earlier in the presentation, activity of the NAO, the North Atlantic Oscillation, the Madden-Julian Oscillation, and even INSO. They capture those signals, but they don't capture them completely. So with that uncertainty, it drives some of our uncertainty in the confidence of our forecast. So for the United States growing season summary, the beginning of the growing season is more concerned with wetter soils in the regions that we highlighted and cooler weather across portions of the plains in the Midwest, while we're concerned with warm and dry weather in the Southwest. It will try and turn drier in the Midwest and upper Midwest after mid-May. Trend is to be hotter and drier in the Southwest United States, but we're expecting the Great Plains to avoid drought. We could still see wetness across the Southeast Plains, Oklahoma into Arkansas, Missouri area, but we're going to watch dryness in Illinois and Wisconsin, so the upper Midwest where we had forecasted dryness as shown in our maps previously. Again, an El Nino, if one is to develop, it'll be later in the growing season. We expect it to be weak and most likely won't develop until later 2017. The warm North Atlantic dry bias for the central U.S. is being offset by the cool Pacific, so it's reducing our drought risk.
Olivia, I'm going to ask you a couple of questions here. It becomes the Q&A portion of our climate presentation. And I just wanted to let everyone know that we'll be taking a 10-minute break before our next segment. Olivia, I wanted to ask you, we've gone into this very wet weather pattern over the southern plains, Texas, over to Arkansas, and up towards the Corn Belt. A bit of a surprise in this current pattern over the next few days and into next week. And you mentioned that Madden-Julian Oscillation caused that. I'm wondering, do you see another event similar to this occurring as we go through the rest of spring into early summer?
I would anticipate another event, yes. That's mainly because INSO is neutral. When it's neutral, the MJO has less of a competitor to say, a less competitor when in regards to struggling to drive the weather patterns. So with the INSO being a neutral phase, I see the MJO being one of the primary drivers of the weather events kind of in the shorter term, 30 to 90 days. So with that, I would anticipate probably another wet event within the next month or so.
Are we going to be more concerned about wet weather in the Great Plains versus the potential for any dryness to develop as we go through the summer season?
The central Great Plains, we're not really anticipating extreme dryness or drought. As for extreme wet weather, like a extreme wet weather event, I'm not anticipating that right now. Like we said, just mainly the wet events kind of in the south around the Gulf area up through Oklahoma, Arkansas, Missouri, southern Mississippi River Valley related to the MJO, but extreme wet events across the central Great Plains, upper Midwest, I'm not anticipating there would be many.
I have one more question. Do I have time for one more question? I do. Okay. I wanted to ask you, with climate forecasts, is CO2 levels involved with the models when they make climate predictions?
Yes, climate models have taken into account the increase in carbon dioxide levels related to industrialization. So it does adequately capture that increase in CO2 that we have observed on record. So that is taken into an account. When you do future climate projections, so out to between 2050 to 2099, that's when you get into the different relative concentration pathways. So that's when we have our low case scenarios where, say, we keep carbon dioxide under control, or you have your high relative concentration pathways where CO2 continues to increase at kind of uncontrolled amounts. So that does feed into our climate models, and we weigh that all and usually come up with, a mean forecast to kind of summarize it all together as to what we could be expecting.
Well, great. Thank you very much. It's a wonderful presentation. Thank you for watching the climate presentation today. We're going to be taking a 10-minute break, and then we'll be back right after that. Thank you.
I'm glad to introduce Nate Losey, who's going to be talking about the Commitment of Traders report. Now, as Noel Fryer was telling us from Europe, there's a lot of interest in understanding this Commitment of Traders data and what it really means. We in Chicago talk about it often. We've done a little work to think about the overall structure of what Nate's going to be telling you. And Nate is our Oilseed and one of our top analysts at AgResource, and I'm happy to give him the mic so that we can all learn a little bit more about the Commitment of Traders data.
Thank you, Dan. I thought I'd start out with just a brief history of futures markets and regulations here in the U.S. Starting back in 1848, we had the Chicago Board of Trade here in Chicago. Started as a cash grain exchange, and very quickly futures markets were established. It was another 22 years. We had the New York Cotton Exchange in 1870. In 1872, we had the New York Butter Exchange. Then in 1876, the Kansas City Board of Trade went online. 1881, an exchange was established in Minneapolis that eventually went on to become the Minneapolis Grain Exchange. In 1898, the Chicago Butter and Cheese Exchange went online here in Chicago, eventually became the Chicago Mercantile Exchange. Also in the 1880s, we had the first attempts by the government to, or at least the first bills to either regulate, ban, or tax futures trading here in the U.S. In 1921, of course, was the Futures Trading Act, which was the first attempt by the government to regulate futures. It gave the Secretary of Agriculture the power to oversee forward markets. One other thing that it did was it also placed a 20-cent per bushel tax on options trades and futures trades that were outside of the exchange. That was quickly challenged. The Supreme Court that year overturned that act, saying the government did not have that taxing authority. The next year we had the Grain Futures Act, which established the Grain Futures Administration. This time it was again challenged, but was upheld as a means of regulating interstate commerce. The next year we had the large trader reporting system was implemented, and of course the following year after that we had the first annual report on hedger and speculator positions. 1933, the COMEX Exchange was established. Then in 1936 was the Commodity Exchange Act, which replaced the Grain Futures Act and was expanded to cover more markets. We had not just the grain markets. In 1938, again, we had the first speculative position limits, and also that year was the first year that segregated funds were required. Through the next couple decades, we had a number of significant events. In the 50s, there was an onion market scandal. In the 60s, there was a big scandal in the vegetable oil markets. And then in 1973, corn and soybean prices hit new all-time highs, and the speculator was to blame. 1974, the following year, the Commodity Futures Trading Commission Act was established, and that put the CFTC in place. In 1979 was the first year we had regulations on commodity pools and commodity trading advisors. Then through the 80s, again, there was a number of new rules implemented, changes to rules, but as far as regulation or the reporting, not a whole lot changed. We were still stuck with monthly Commitment of Traders reports. In 1992, that switched to twice per month. In 2000, we had weekly reporting started. Then in late 2006, the CFTC announced that they would begin a new report called the Supplemental Report, which took the traditional reports of commercial and non-commercial traders and stripped out index fund traders. And then in 2009, the CFTC began disaggregating trader data to the reports that we have today. Now, again, there's three different types of reports that are still available. They all start with the larger trader reporting system. Traders are either thrown into the bucket of a reportable or a non-reportable position. Those levels vary by market and are controlled by the CFTC. The legacy reports the traditional reports are still published, and they simply break traders out into either commercial or non-commercial traders. Again, the supplemental reports have commercial, non-commercial, and index fund traders. And the disaggregated reports that we have today break traders out into producer, merchant, processor, and users, all one category, swap dealers, money managers, and other reportable traders. And of course, all of these reports are available with or without options. The disaggregated traders groups, producer, merchant, processor, user, pretty straightforward. Anybody that produces, uses, or trades the physical commodity and needs to hedge out risks. Swap dealers, probably the least easy to understand, but it's really any entity that engages in swap transactions and needs to hedge out the risk of those swaps. And swap dealers can work with speculative traders like hedge funds or work with traditional commercial clients. Money managers also pretty straightforward. It's any commodity trading advisor or registered commodity pool or any unregistered fund identified by the CFTC. And of course, these are the people that are managing clients' funds and taking long or short positions in the markets. Other reportables are any other reportable trader not categorized in the other three. That can be any individual maybe that has a reportable position. And the interest in the commitment to traders data very clearly from this chart is in fund positions. You know, we can see very clearly there's definitely a relationship between positions and price changes. And of course, the debate is always which one causes the other. We can look back in June 2015. You know, price bottomed, positions kept getting shorter, price started to tick up, positions got even shorter, price continued higher, and then finally funds started to cover, and then price and position all moved in the same direction, accelerated up. Price topped out first again, positions got longer, price turned down, positions got even longer, and then again they all moved the same direction and accelerated down. Looking at last spring, kind of the same scenario to start with. Price bottomed, positions got shorter, price started to turn up, but this time funds quickly covered and price and positions all moved up very quickly, and this time it looked like positions were leading price. When we got to the top, positions topped out, price topped out, positions turned down, and then price turned down. And so, you know, again, we can look through these markets and find instances where price led positions and other instances where positions led price. It's the same data just extended back to 2006, and again, kind of the same thing, 2007 and 8, positions led price, positions turned down, and then price continued higher on into 2008 and didn't top out for another year. And then once everything was moving in the same direction, you know, really accelerated down. There was a period in 2009 where positions and price seemed to move very harmoniously, but again in 2010 and 11 there was a period where price did absolutely nothing, just stayed in a very narrow range. Positions swung by over 100,000 contracts in each direction, and for all that work up and down, funds got very little return. But again, you know, we could go through many examples, and there's times where price leads positions, and other times when positions leads price. Now, ahead of the conference here, there had been some questions from people apparently wanting to know which data is the right data. And I think the answer to that is it doesn't matter as long as you look at the same one, at least from an abstract view. You know, we have managed money, we have non-commercial positions, and then of course both of those are available with or without options. You know, this chart here shows the 4 data sets. They all tend to move in the same direction at the same time. And so if you're looking at it just abstractly, I don't think it matters as long as you're looking at the same set consistently. For those that want to, you know, narrow down their focus, you know, you can see in late 2010 there was a big difference in positions. Non-commercial without options was at a record net long. With options was significantly lower, and that was because non-commercial traders were net long futures, net short options. And so those maybe are the times where we can find some opportunity in the markets. Here's the same data, just narrowed in down to the last 3 years, and again you can see the variation in positions, especially they really start to spread out at the tops or bottoms. You can see in late 2014, 3 of the 4 data sets were net short. The managed without options stayed net long. Now, of course, if you're focusing on funds, your funds typically hold 20 to 30% of the open interest, so that means you're ignoring the other 70 to 80% of the market. Here we have managed funds net position in black on top, and we have hedgers net position on bottom, and you can see they're really almost mirror images. And I think basically what this shows us is when price goes up, funds buy. It's the fluid money, the money that can change direction easily. And producers, when price goes up, obviously are sellers. And when price goes down, funds sell, and when price goes down, producers are more focused on basis and looking for opportunities to cover their hedges and move the cash grain. So you could focus on funds directly, or you could look at hedgers as a inverse indicator. But oftentimes they're almost mirror images. I also want to take some time and look at some of the data that's even less talked about, and the CFTC takes positions and breaks out in grains by old and new crop positions. And here is soybean new crop short positions. The CFTC's reporting, they break that down in the last month of the year. So August 1st, August gets rolled forward, and we start the new crop year as far as the CFTC's reporting is concerned. So here this year, 2016-17 new crop hedges are the lowest since 2008 and 2009. And looking back over history, that last week of the crop year typically has accounted for the short positions has represented anywhere from 35 to 50% of the crop. 2006 was an anomaly at 20%. In 2012, with the drought, we had a short crop, and of course record prices. It was encouraging producers to sell their crops sooner than later. At that time, almost 82% of the crop was hedged at the CME at the end of the year. And what would be really great is if we could take that data and relate it to crop size. And the relationship here, there's definitely a positive relationship. When producer hedges are larger, the crop size tends to increase. But it's definitely a very loose relationship, and we wouldn't want to use it to try and project crop size. And here again, the old crop, new crop data. We have the managed funds with options. Very rarely do have funds in the past been short soybeans, and it's even more rare that they're short new crop soybeans alone. We can see last week funds were overall net short soybeans, but drilling down in the data, we can see it was short old crop, and they had a slight long position in new crop soybeans. Finally, I think where can you get the data? CFTC website. You can go there and read get the reports right off their website. You can download the spreadsheets. Most of the news and commodity quote software programs offer some sort of access to the data. But of course, you can go right to the CME website. They have this wonderful free app. You can click through the different trader positions. You can adjust the look back period. They have a really easy to use tabular form, and just do a simple Google search for CME and commitment of traders, and you should be able to find that link that's right there at the top. And finally, in conclusion, there is definitely a strong correlation between changes in agriculture commodity futures prices and changes in fund interest. The CFTC commitment to traders data holds very little predictive power. Fund net position and changes are a measure of sentiment. Current measurements are relative to the current environment, and interpretation is very subjective. Comparing net positions today to several years ago may not be relevant due to changes in position limits, margin requirements, cost of money, price of commodities, and a host of other variables that go into making those decisions.
So thank you very much, Nate. Great presentation, and I learned a lot, particularly on new crop, old crop soybeans, and all that kind of stuff. We're going to move this way a little bit to get in the flow of the camera. That being said, so I understand the relationship is loose. How would you use commitment of traders data as another tool in your box if you're a trader? So if we're sitting in France today, you and I, and we're having this discussion over a baguette, would you tell tell the French that they need to have commitment to traders data, or what would your advice there be?
You know, I think it's always interesting data. It can be helpful, and just again, as you mentioned, another tool in the toolbox.
Thank you very much, Nate. I enjoyed it very much. Our next speaker will come from Brazil. We thought it very important to give you a real highlight or an upper level view for 10 or 15 minutes of what's happening down in Brazil due to the corn crop and everything else. So Tarso Veloso will be coming up. We will give him an opportunity to talk about the Brazilian market. I'm just being told there'll be a small break.
And that's it. From 2000 to right now 2006, South America took the lead on production of corn and soybeans in the world. Right now here in this slide, we can see how Brazil, how the agriculture is important to Brazil. It represents 21% of the GDP as 2015, and probably this year, due to the crisis in Brazil, it's going to be even more than that, maybe 25, 26%. The South American acreage, as you can see, it doubled. In 20 years, we came from a little bit less than 40 to 80 million hectares. Here, the South American production, if we sum corn and soybeans, it's important to notice that we are above 300 million metric tons right now for this year. If we talk about agriculture in Brazil, it's really important to talk about Mato Grosso. The state represents roughly 30% of the soybean production in the country and a little bit less than that on corn. And as you can see in that slide, it's only 11% of the area in the state is actually being used right now, while you have 26% of pasture, especially on north of the state, as you can see right now, that it can be transformed to cropland. This is the safrinha development in Brazil. In 2000 was 1 million metric ton only for the state, and right now is 26 million metric tons this year. So it's a huge increase, and it's right now a share of 29% of all the corn that Brazil produces. Here we have the soybean, same chart. We started with 9 million metric tons, and right now we have CONAB saying 30 million metric tons. IMEA says 32, and probably CONAB is going to come closer to IMEA as we move forward and we see the less yields that we have so far. This is an outlook made from IMEA, and they forecast that Mato Grosso is gonna be harvesting 39 million metric tons by 21-22, and as you can see this year, it's gonna be probably 32. We're gonna be above that if nothing changes. We have for corn here the same. As you can see, 28 million metric tons this year. It's already also too low because Mato Grosso this year is gonna harvest more than 22. So we have like another 10 years to see that number coming up. This is a crop tour that's made in Brazil right now. They finished a couple weeks ago. It's a few consulting companies and a few media newspapers. They go out and they see the yields per bag per hectare in Brazil. This region is the biggest production region in Brazil. It's Mato Grosso and all the Midwestern of Brazil. And we can see the differences, 10% and 13% in Mato Grosso yields, 9% in Mato Grosso do Sul. It's Goiás, it's 8%. And it's a huge increase, and that's why we had last year a crop of 96 million metric tons, and this year AgResource believes we're going to harvest 111 million metric tons. This is the new frontier in Brazil that is started being used as a cropland maybe 5 to 6 years ago. It's called Mapitoba, and englobes 4 states, and it's kind of weird right now. The weather there is not as stable as it is in Mato Grosso, so we have a lot of weather problems year after year, and we can see how the difference between last crop and the current crop, especially in Piauí, 157% increase on yields in soybeans. We can talk about logistics in Brazil. As everyone knows, we always had a lack of infrastructure to transport the grains from the farms to the ports. And I think the worst year was 2013, when we had those huge lines. You can see in the slide in the bottom, those huge lines of trucks going to Santos. More than 100 miles of traffic. Trucks just stopped in a highway. And then the government decided to start scheduling times for trucks to arrive at the port instead of just everyone waits to see when they needed to go. And the government started investing in the Northern Arc. It was a strategy of taking the grains on north of the country. And as in Brazil, everything goes a little bit slow. All those improvements are also behind the date, but they are being made. So you can see right now you have like Mato Grosso. You can see the the yellow stripe coming up. That's one of the most important routes right now that goes straight to Miritituba port, and then goes by boat out of Brazil, and then Panama Canal, and then China. And only that small change, instead of driving 2,000 kilometers south to São Paulo, you go north, you save 4 days for trip to China, and you slash costs. That's the Northern Arc in detail, and showing the change in the Panama Canal. Here's the explanation how the Northern Arc is being more important to Brazilian logistics. So Northern Arc increased 58% over the last 3 years. And while that, the normal ports in south of Brazil, Santos, Paranaguá, and Rio Grande, they're losing market share, which is good because they're way too far away from where actually the production is. If you can see the darker colors on that slide, it shows where we have the biggest production in Brazil, and Mato Grosso is by far the biggest production. So the south states, they're close to the ports, no big deal, but Mato Grosso needed that solution, and the government is investing money right now to make sure that happens. Here's the map of Argentina's production, also a small country, a lot of ports on the right side, and here you can see the difference in the cost from Argentina, Cordoba, to Sorriso, Brazil, which is the biggest city in production in Brazil, probably the world. And here the prices in Mato Grosso, you can see the red color. The more red it is, the more expensive it is to move around, and it's $95 a ton to get out of Mato Grosso. While in the south of Brazil, you can see it's probably very close to Argentina's cost. Talk about a little bit about the country and economics. Everyone knows that Brazil is going through a major crisis right now. Unemployment is 13 or 12% of the population, and we can see how the GDP is going down sharply because of that. The inflation in Brazil is going up too, while Argentina was always high like that. That devaluation on the currencies last year made a lot of money for producers in Brazil, Argentina, and Ukraine. Especially in 2016, you can see the dip. That's where the prices of soybeans in Brazil were heck or high, even higher than 2012 drought in US. Okay, here's the prices. So you can see from July 16, how they peaked. And here where they are right now. Cash prices in Goiás and Sorriso, Mato Grosso. And 16 is all-time high, and right now is way down. So that's why Mr. Basse was saying before, the Brazilians, they already sold 60% of their crop, but right now they're still holding to see if the currency is going to help a little bit more, or we're going to have a rally at the CBOT. That's the most complicated part of my presentation right now, because all the crisis in Brazil, the economic and the political derivates from that. That's my colleague Mateus, another member of the AgResource Brazilian team, made for us to explain. I know he looks confused, and because it is confused. So we have President Dilma using the red shirt. She got impeached, and now Michel Temer, her vice president, took the office and is doing a lot of unpopular measures. Last night, the Congress approved the reform in work laws. And in Brazil, it's usually, like we joke here in America, like Brazil has awesome laws for the employees, and now the government is starting to change that. So tomorrow, we have a total paralyzation in Brazil. It's a strike. Pretty much all the categories in Brazil, transportation, cops, health, everyone is going to stop tomorrow to complain and to protest about the changes that Michel Temer is doing right now. The judge on top of Mr. Temer, the far right on the top, it's a judge. It's called Sergio Moro, and he's the guy doing the investigations behind the car wash scandal in Brazil. And 2 weeks ago, they indicted 108 politicians from Brazil due to bribes or problems in campaigns. Here we have, I think South America right now, it's here to stay. We have a vast availability of land. According to ABIOVE, the Association of Vegetable Oil Industries in Brazil, the Cerrado region, which is in Globos Mato Grosso, Goiás, it has more than 60 million acres that can be used to crop without any deforestation. So we have available land, we have improvements in infrastructure going on right now, and we can tell we have way less lines on trucks and on vessels and ports. We have weaker local currencies right now. Usually in Brazil, the last 10 years, we can say $1 was the equivalent of 2 reals, and right now we can see that 3.30. So that's helping the Brazilian producers to profit even more. And right now we have a slightly chance of having lower interest rates for producers to get money in bank. Usually in Brazil, the APR is around 10%. So the producer has to pay 10% to the bank to get money to pay his costs. And the minister right now, Blairo Maggi, he promised that this number is going to go down to 8, 7, 6, at the same time that the Brazilian Central Bank lowered the benchmark interest rates. And right now we have producers in Brazil are cheering for a weather problem in U.S. because local prices in Brazil, as we've seen before, are very low compared to what they were last year. And right now I'm going to give back the word to Mr. Basse for the final comments. Thank you very much, sir.
Tarso, you're not going to get away from us that quickly without a few questions. And the name is Dan, not Mr. Basse. Quick question. I mean, we talked about Brazil, and in particular, the big technological change in my mind has been safrinha corn. What does safrinha mean in Portuguese?
We call it a small crop because a few years ago, 5-6 years ago, was a smaller crop we had. It was the first crop during the summer, was the biggest crop. And safrinha was just a small.
So safrinha means small in Portuguese. Yes. Should we rename the Brazilian crop?
I think we should rename the safrinha. We can call it in Portuguese safrão.
Okay, saffron crop.
Saffron crop,
The reason I ask this because the biggest technological change when I look at agriculture is that we are now producing a 60 million metric ton second crop of corn in Brazil, many times larger than that. And it looks like agronomically, you would imagine Brazilian farmers will keep doing that year after year, don't you?
Yes, I think the land is available in Brazil, and producers they're already paying the cost for the loan and everything. And I believe like if the weather is being good, they have no reason for not seed and move ahead making 2 crops. I know that close to Brasilia, the capital, we have 3 crops in a year. So if the land is available, producers will plant.
So we'll get 2 crops a year, soybeans followed by corn, and there's more land that we can bring into production. So Brazil's going to be an agricultural powerhouse.
Yeah, that's what I was showing a presentation right now. The GDP, the agricultural GDP corresponds to 21% of the total country the GDP, and we see that getting even bigger because we're going to have an increase in technology, increase in area, and with the weaker currency and the producers making more money, it's going to incentivize more people to do that.
Okay. Well, thank you again. Great presentation. I guess Brazil and South America is the place to watch, at least for the next decade. Thank you, Tarso.
Thank you very much.
Well done.
Thank you.
Well, we've come to the conclusion of Cereal's conferences. If I could have my partner in this conference, Noel Fryer, come up just for a minute. We'd like to thank all of you for watching. To me, and I wanted to bring Noel up because as I think back to all of the presentations today, there's some things that stuck in my mind. Number one is that as I look at any bullish commodities, and we may have found a couple, but they're hard to find, we really had to look hard today. And maybe that is things like hard wheats, spring wheat or Durham wheat, maybe Kansas City wheat futures if there's a problem somewhere in the Black Sea. I also think maybe soybean oil due to biodiesel and policy from the U.S. government in terms of a producer credit or anti-dumping claims. Other than that, Noel, did you see anything? I mean, we're still in the same landscape. There's a few things that can come around the edges. I thought weather was very interesting. We had the Black Sea issue being the predominant one in the United States. It looks like we're going to have an okay growing year with maybe a few scares. But really, I guess my eyes will be focused on the Black Sea and Europe going forward.
Yeah, I think that's absolutely right. If there is any kind of bullish story around today, it's going to be the quality wheats, which will be in terms of the weather in North America, U.S., Canada, and potential weather in Southeast Europe and the Black Sea. Otherwise, bean oil, of course, depending on how the whole biodiesel fuel story pans out. I think that the thing that stunned me the most was what Tarso said just now. 60 million hectares of arable land in Mato Grosso alone with no deforestation. That has to scare the hell out of the U.S. bean farmer, I think.
It does, and when you look at the cost of production of the Brazilian farmer versus U.S. farmer being the U.S. farmer is now the high-cost producer in corn and soybeans, it is a concern, and it's really been the U.S. farmer that has been enduring most of the financial pain. This is where currency all plays its role going forward. But, again, thank you for joining us today. We hope you found the whole conference enjoyable. We had a little technical glitch early on, but we've now got the speakers and everything ready to go. We may put this presentation back up on YouTube so you can watch it one more time. We want to see how the markets and everything perform. But thanks again for your time today. We are going to shift to just a little quick here. I guess we have the Board of Trade series, and we're going to shift to her in the end. But again, Cereal's Conferences is now closing. We enjoy your participation, and we hope to see you again.
Thank you.